Good morning, everybody, and happy Friday. Today is November 17th, 2023. The big story this morning is the D word, deflation, straight from the mouth of the CEO of Walmart, saying that inflation is falling. Obviously, we've all seen inflation is falling. Obviously, not falling as much as is being claimed. See also that 34% reduction in health insurance costs. Congratulations, everybody. I don't know where I'm going to spend it all. But we are seeing from retailers, especially from consumer-facing businesses, Target, Home Depot, Walmart, we're seeing the same trend. We've been seeing it all year, a decline in same-store sales. And that is so important in the retail industry. Same-store sales, that is the end-all, be-all statistic that you need to watch because it accounts for stores opening and closing. It accounts for all these different accounting gimmicks. Same-store sales is where it's at, and they're falling virtually everywhere. They're actually going up in a few key places, though. You know where they're going up? Just this morning, Ross, discount clothing retailer, they're reporting same-store sales growth of 5%. Now, why is that? Probably because people can't afford to shop at Banana Republic or Gap or wherever else they're going. I don't know. I'm so out of touch with the fashion industry. It's not even funny. But Ross is seeing a lot more foot traffic. People are spending more money at the discount retailers. Why? Because they're broke. Claudia Sam, who says most of us are better off. Yeah, okay. Again, it's not rain dripping down your back. So people are trading down, spending more money at the discount retailers. It's leaving the high-end guys high and dry. We're seeing it at Target, not exactly high-end retailer. Walmart, neither are they. Home Depot, same-store sales falling all across the economy, gaining steam in places where it's not really a sign of economic prosperity. You know what else we saw recently? We got an analyst from Wedbush who tracks CarMax put out a note yesterday. Says auto delinquencies, they are on the rise. I believe it was for the month of September. Auto delinquencies for CarMax rose by 59 basis points. That's people who are at least 30 days behind on their car payments. 4.75% of borrowers are now delinquent on their car loans, people who finance via CarMax. And just some of the data that came out in that note, 17.5% of all the buyers in the third quarter had payments of $1,000 a month or more for a car. $1,000 a month car payments. Unbelievable. Guys, the solution to higher prices, it's not higher taxes. It's not more government spending. It's not windmills and solar panels and electric vehicles and unicorns and rainbows. The solution to higher prices is higher prices. Now, I just want to add, guys, because I know I'm going to see these comments today. I get them every time I use the D word. People are going to say, my food bill is still so much higher. My cost of this went up and this. I get it. And that is not going to change because we've seen this year, we have not yet seen any deflation this year. Even though I've been calling for it for a while this year, it hasn't happened yet. We have seen disinflation, which means prices are still going up, but they're going up slower. That's disinflation. Prices still trending upward. And so, yes, your stuff is more expensive than it was a year ago. But what I'm saying is the rate of that increase is slowing. It's going to slow all the way to zero. And eventually it's going to go negative, which means prices will start coming down. But don't expect any relief, guys. Those prices coming down, it's not going to be a good environment to be in. Because when prices come down at the grocery store a little bit, when prices on your utility bills come down a little bit, the value of your house goes way down. The value of your stocks, your 401k, goes way down. So while consumer deflation will help, especially the poor the most, assuming they don't lose their jobs in this deflationary mess that's coming, then their cost of living gets a little bit better. But the government probably won't stomach deflation for very long because you know who deflation hurts the most is people with a lot of debt. And who's got more debt than Uncle Sam, currently sitting at, $33.7 trillion? Well, if we get deflation for very long, that $33.7 trillion, maybe numerically it doesn't get any bigger, but relative to goods and services, it gets a whole lot harder to pay off. Because remember, during deflation, your tax revenue also starts to fall. And as people lose their jobs, more people go on food stamps and unemployment benefits and Medicaid. So the government's costs go up. So deflation, although it sounds good after living with inflation for a while, brings a whole new set of problems. And with that, let's shrink my big melon of a head. And that also means it's time to smash that like button, guys. Really helps for the YouTube algorithm. If you're liking this stream, hit that like button so everybody can like it. And, of course, hit that subscribe button also. We do this every day. Have your coffee with the Melonheads every morning. The S&P is up just 10 points ahead of the opening bell this morning, 0.25% higher for the S&P. We got the Dow is also a little bit higher this morning, 117 points up to the upside, about 1/3 for the Dow. And the NASDAQ, interestingly enough, into negative territory right now, down just 6 points, a fraction of 1%, but red nonetheless. Looking across the commodities board, we got a lot more green today. It's probably because of a weaker dollar. Gold is trading at $19.88. That's for December gold futures. That's up $1 this morning. December silver futures at $23.95. Can't quite crack that 24 handle. That's up about a penny this morning. We have got platinum and palladium are both down a tick. West Texas Intermediate crude oil futures, December trading up 76 cents at just 73.66. Let's talk about oil for a minute because talk about deflation, guys. Check out the price of oil here. You know, it had been coming down since we got some of those big inventory prints. We got that step up on the outbreak of war in the Middle East, which was actually a very muted reaction considering what price of oil has done during Middle East conflicts in the past. And then the demand side took over again. We got some more lousy oil prints, oil inventory data, and the price of oil got just bludgeoned yesterday. This is not a soft landing chart here, guys. Remember, oil supply is getting tighter right now. The Saudis and the Russians have cut production this year, so there's less oil on the market than there was a year ago. And yet, look at what the price is doing here. This is demand destruction visualized. You're seeing this. This is less economic activity. We've seen it with the truckers. We've seen it with the shippers. There's less stuff moving across the pond and over the roads, and so you need less diesel to carry it. Means you need less oil. People can't afford to shop as much, so they're not driving to the store as much. All across the economy, things are slowing. Manufacturing is slowing. Everything is. Where does this soft language talk come from? Where? What? Okay, because NVIDIA stock is up. Congratulations. Does that mean this isn't happening? No, it does not. Looking over at the DXY, we have got the dollar is slightly weaker today, down 22 basis points at 104.13. Dollar continues its slide today. And the bond market, we got a mixed bag. The super long end of the yield curve is down just a little bit. The 30-year Treasury down 1 basis point at 4.61 this morning. 10 years flat at 4.44. We got the 2-year a little bit higher, 4.869. That's up almost 3 basis points. And the 1 month is up 1 point at 5.399. Talking about the bond market a little bit here. Check out reverse repo from yesterday, $912 billion. I just wrapped up an interview with Joe Brown yesterday. I'm probably going to post that one tomorrow. Just give you a couple of data points, guys. Since Monday, reverse repo has dropped $108 billion. It's dropped $1.3 trillion since the end of May and the suspension of the debt ceiling. And this is the liquidity pool. This is it, guys. This is what's left in the bond market to satisfy Aunt Janet's borrowing demand. And, man, we are right on that red line. I haven't moved it. I'm not going to move it. Right on that line at the moment, on pace to hit zero sometime in the middle of February. And what is contributing to that? Well, here's one story that may be contributing to that. Foreign ownership of Treasuries falls, hitting the lowest point since May. This is in Barron's yesterday. Foreign holdings of U.S. government debt fell in September, snapping 3 straight months of increases, the Treasury Department data showed on Thursday. Total foreign ownership of U.S. Treasuries fell to $7.605 trillion in September. That's down from $7.707 trillion in August, so about $100 billion lower. That marks the lowest level since May, when foreign ownership stood at $7.52 trillion. The decline comes as the absence of foreign central banks and non-U.S. private investors has become increasingly evident at Treasury auctions. The latest 30-year auction a week ago, for example, saw indirect or foreign bidders take 60.1% of the debt on offer versus an average of 69.3% over the past 6 similar auctions. Japanese investors, historically the most active buyers of U.S. government bonds, owned $1.1 trillion of treasuries as of September. That's the lowest level since March of this year, Treasury data showed. Important note here, to be sure, total foreign Treasury holdings are still higher than a year ago, but Thursday's data supports the broader narrative of foreign investors starting to step back. So yeah, maybe total foreign holdings are a little bit higher, but remember, total U.S. government debt is a lot higher. So foreign buyers are not stepping up to absorb all this new Treasury issuance that Janet Yellen has been making. And so market's having a harder time finding buyers, which means the price is dropping, which means the interest rate is going higher. So who is going to buy the U.S. government debt? I guess we're going to find out soon enough. $900 billion left in that reverse repo, 912. And here is the big one this morning. This is the D word that you got to worry about. Deflation makes a shock, unwelcome appearance at Walmart. Almost uniformly, consumers are pushing back on price. That's according to Gordon Haskett's Grom. I don't know who that is, Gordon Haskett's Grom. If we learned anything over the turmoil of the past 2 weeks, it's three things. By the way, turmoil of the past 2 weeks, the stock market has gone straight up for the past 2 weeks. And they're talking about the turmoil. It's amazing. In one article, they'll talk about the soft landing and the euphoria. And then in the next article, we hear about the turmoil. That's interesting. Same news outlet. If we learned anything over the turmoil of the past 2 weeks, it's three things. The Federal Reserve is probably done raising rates. Consumers of all types are balking at price increases. And inflation is clearly coming down, at least for now. 34% reductions in health insurance notwithstanding, of course. Walmart even raised the specter of outright deflation on its earnings call today, saying prices could fall in 2024 as shoppers pivot from mere grumbling about higher costs to changing their behavior, shifting to cheaper goods, or snapping wallets shut entirely. We are more cautious on the consumer than we were 90 days ago. Guys, 90 days ago, they were pretty cautious on the consumer also. That's according to Walmart's CFO, John David Rainey. But it's not just Walmart. Almost uniformly, consumers are pushing back on price. Gordon Haskett's Chuck Grom said today on Surveillance, citing Target and Macy's as among those retailers feeling the pressure. You're seeing it across the board, guys. Retailers, same-store sales are in decline. They're tightening their forecasts or at least not raising them. All of them giving warnings about reduced demand, weak demand. Consumers are struggling, drops in savings, all except Ross. Ross this morning, again, when you see the discounters doing well, that's not a good indicator for the economy. Ross sales and profit rise as retailer rides resilience of the off-price sector. And that's not necessarily resilience. That just means high-end consumers are being punished down into becoming Ross shoppers. And so it's offsetting the people who are spending less in the store elsewhere. Customers are responding to Ross's terrific value, the CEO says. Ross shares rose more than 4% in after-hours trading on Thursday after the discount retailer reported a better-than-expected quarter and tweaked guidance for the year, saying people reacted favorably to its off-price merchandise. Sales rose to $4.9 billion from $4.6 billion a year ago, and comparable store sales rose 5%, the company said. That's the big one right there, guys. Those same-store sales up 5%. So all the losses happening at the other retailers, that is Ross's gains. See also stores like Marshall's, TJ Maxx, probably doing pretty well in this environment also. We are pleased that both sales and earnings outperformed our expectations for the quarter as customers responded favorably to the terrific values we offered throughout our stores. That's according to CEO Barbara Rentler in a statement. So Ross doing well, seeing the benefit of everybody else not doing so well. Why is everybody else not doing so well? Check out this data point. This is personal savings rate. This is the amount of discretionary income that is left over after everybody pays their bills and goes out to eat. Personal income, the personal savings rate is down to 3.4% in the U.S. That's as of September. We'll get another data point in about another week or so here. Down off its highs for the year that we saw in May of 5.3. Although we saw a low last year around 2.7, but the trend is pretty clear here. The stimmies flow, the helicopter money comes out pumping. Everybody feels rich. Oh, thank you so much for my government checks and my expanded child care benefits and PPP loans and all that other stuff. Thank you so much, government. Everybody thought they were being given something. I tried to warn people back then, guys, when they give you $600 in your mailbox, that's only because they're stealing $6,000 from you somewhere else. Nobody was listening back then. Everybody said, oh, don't worry. Yeah, we might see some inflation, but it'll be transitory. And now look what's happened. It turns out those stimmies, they really weren't a gift. It was just a distraction to make you forget that you were being robbed. And now that we've spent a year and a half, 2 years living with inflation, now we've got nothing left. Now the personal savings rate is wiped out. I mean, zoom out on this chart and, forget the noise of the pandemic, guys. Look at where we're settling right now. First of all, here's your return to normal bounce, and we're about to head lower. But look, pre-pandemic, before this thing broke out, the personal savings rate was around 7%, more than double it is right now. And even in the middle of the teens, all throughout the last decade, we were averaging about 5.5% for personal savings rate. And now it's down in the low threes and heading lower. Again, these people who are saying we're better off financially than we were before everything started, what are you looking at? What possible data point could you be looking at, you hypocritical twits, to be saying that we're better off financially? Unbelievable that people are still saying that. Moving on, this is another big one we got today, or came in yesterday from CarMax. Auto loan delinquencies are spiking, analysts say. CarMax stock is falling. A phase of higher defaults on auto loans may be starting, which would be bad news for CarMax. On Thursday, Wedbush analyst Seth Basham reiterated his outperform rating on the stock, but he lowered his price target based on the dealer's auto loan data. All right, so remember, he's reiterating his bullish bet somehow, even though people aren't paying their loans. But check out the data in this note. The analyst said the data showed the share of loans delinquent by 31 days or more rose by 59 basis points in October from September, putting it at 4.75%. That's the highest this year. The average move at this time of year is typically a decline of 6 basis points. Instead, we got an increase of 59, or 1/100 of a percentage point. Affordability may be an issue, according to Edmunds. 17.5% of buyers who financed a car in the third quarter had a monthly loan payment in excess of $1,000. Good God, $1,000 car payment. I've only ever had in my whole life, I've only ever had a car payment for like 3 to 6 months. I buy my cars for cash. I own them outright. I hate car payments. But despite deteriorating loan numbers, he's still bullish on CarMax stock somehow. Why? Probably because numbers go up. Moving on from auto loan delinquencies, China vows to meet reasonable funding needs for developers. Here we go. China's government putting pressure on banks to try to eat the losses from the development sector. We've been talking about China a couple of times this week. Remember, we talked 2 days ago about how the total area being sold of new homes was down substantially versus a year ago, that it's still falling, and it's accelerating as it's falling. And then we talked yesterday about how the prices of homes per square foot are falling. And not only are they still falling, but they are falling faster, accelerating to the downside. And now here we've got the Chinese government leaning on banks saying, we don't care what the numbers say, you will make more loans. Don't make me disappear you in the middle of the night. China's regulators told the country's biggest banks and asset managers to meet all reasonable funding needs from property firms in the government's latest bid to arrest the protracted slump in the real estate market. In a meeting on Friday, the People's Bank of China, the PBOC, that's China's Fed, the National Administration of Financial Regulation, and the China Securities Regulatory Commission told financial institutions to support property developers in receiving loans, issuing bonds, and ensuring reasonable equity financing from capital markets. You got to love that, ensuring reasonable financing. These developers are so hopelessly indebted. They have built buildings that nobody wants, that if anybody even tries to live in, they're probably going to collapse under the weight of it. And then the bank is saying, we want you to support reasonable loans to these outfits who already have no hope of ever repaying the loans they've already taken. Regulators in China are desperate. China's home prices dropped the most in 8 years in October. New home prices in 70 cities, excluding state-subsidized housing, declined 0.38% from September, the steepest fall since February of 2015. The data adds to mounting evidence that Beijing's efforts to support the housing market have had little impact so far. Stimulus measures rolled out in major cities since August haven't stopped sales or investment from contracting, and the deepening gloom around property continues to hinder China's economic recovery from the pandemic. Guys, the China reopening story was a dud. The China housing collapse is continuing. It's accelerating. And China's just trying to lean on the bankers, saying, you guys eat the cost of this. Isn't that nice of them? And one last thing I want to mention. This is an interesting story I just caught wind of. Greece sells third bank stake in rapid privatization drive. I wasn't really aware of this story, but this is interesting. Not going to get too far into this one. Greece, during the sovereign debt crisis in Europe, I think it was in 2015, when everybody in Greece was going bankrupt, the government was trying to get loans and bailouts from the IMF. Well, Greece bailed out their banks during that time. The Greek government created this fund, and they bought stakes in all the major banks in order to inject liquidity into the banks and to stop them from collapsing. Well, now Greece is slowly starting to sell their stakes in these banks that they've been holding for a few years. Now, there's a few ways you could look at this. You could say, okay, the worst is now behind them. Greece is trying to normalize. They're selling off the stake. The bailout worked. Another way you could look at this is Greece is saying, well, crap, there's probably another banking crisis coming. We better reload the bazooka before we have to do this again. And so they're trying to make room in this bailout fund, raise cash in it before this starts happening again. There's two different ways you could look at that. But Greece hasn't really been making headlines for a couple of years now, so I was a little surprised to see this one. It's just something to keep on your radar. And I want to say thank you so much to Mr. Mike Kathman. Mike says, Jack, my wallet says grocery up 50 to 100%. So what numbers are they using? Well, Mike, I can tell you, first of all, they are saying the prospect for deflation. So they're not saying there's deflation right now. The other thing is keep in mind the time frame. When did that increase in your food inflation? When did it take place? Was it from 2020 to 2021? Or was it 21 to 22? Or did it happen from February to August? Because right now, when we talk about inflation, we're talking about this point in time versus 1 year ago. And yes, food inflation actually is still pretty high. We had food inflation numbers. I don't recall off the top of my head, but they were accelerating to the upside last month. Food was one of the categories that went up in the CPI. But other categories are coming down. Cars coming way down. Used cars anyway. New cars are staying stubbornly high. Again, the auto insurance number that was clearly not auto insurance. The health insurance number was clearly BS. Auto insurance is a category that's still getting a lot higher. Life is still getting more expensive, Mike, to your point. It's definitely still getting more expensive. The point of disinflation is that life is getting more expensive slower now than it was a year ago, and that the rate of that slowing is picking up steam, and that eventually it's going to slow all the way down to nothing. Now, that doesn't mean prices go right back to where they were. It means prices stop going up. But then deflation means the prices start to come down, right? But again, the thing about deflation, keep in mind, asset prices also deflate. And typically, asset prices deflate before the consumer prices deflate. So before we see the price at the grocery store come down, before we see the price of a car start to come down, we're going to see the price of assets, financial assets, come down first. We're going to see bonds coming down. We are going to see stocks coming down, houses coming down before we actually get to that consumer deflation. Because as always, the little guy is the last one to see any of the benefits after he eats all of the cost of everything that's happened already. Thank you very much, Mike. Appreciate the super chat. Support of the channel. Thank you, Easy Fix. Appreciate the super chat, sir. Says, hi, Jack. Today's my birthday. Would you make my day and do your best yelling, explaining Biden why the reverse repo is empty come February? Well, Mr. President, I just want to say the reverse repurchase agreement. Hello, Mr. President, over here. Please pay attention. Thank you, sir. I just wanted to say that the reverse repurchase program is starting to. Why is he walking away again? Why now he's going this way? Mr. President, please. This is very important, sir. This is important how we remind you of our strong and resilient. I give up. I quit. I'll be collecting speaking fees now. Thank you very much. Happy birthday, Easy Fix. That is my Dance Monkey Dance, Janet Yellen on demand. Appreciate the super chat and support of the channel, sir. And thank you, Steve Woitis, for your super chat and your support of the channel. My customer and automotive parts manufacturer told me that due to the low EV demand, car manufacturers have slowed part orders to make up lost revenues. That's interesting, low EV demand, because I have read that EV demand is still growing, but it's growing a lot slower than EV production is growing. And so you're getting a buildup of inventory on these lots. It's not necessarily shrinking demand. Its demand is not rising as fast as we thought it was. At least that's what I've read. Now he's saying the parts manufacturer that due to low demand, the manufacturers, there we go, they've slowed parts orders. So there we go. The manufacturers are realizing that they have overproduced. And so they're going to step back a little bit, give the consumer time to catch up, which might be more time than they realize because cars are unaffordable. See also the delinquencies at CarMax. So, yeah, now that I take my time and read this more carefully, Steve, I agree with what you're saying here, and this does fit what I've read. The manufacturers realize they've overproduced. They're starting to scale back a little bit. That doesn't necessarily mean EV demand is falling. It just means it's not exploding like everybody's telling us in the press that it is. Thank you. I appreciate that anecdote. That is a good data point. And remember, guys, the car and the automotive industry and its impact on the economy, it's not just new car manufacturers. You have a whole automotive supply chain, parts manufacturers, mechanics, insurers. So much of the economy is determined by autos. And that industry is struggling right now. And it's probably going to get worse because they all just wrote out big raises with these UAW contracts. And we're already seeing Stellantis is starting to offer buyouts to their white-collar guys. I think we're going to be hearing more from the auto manufacturers and the rest of the auto supply chain in the not-too-distant future. Thank you, Steve and Easy Fix and Mike Kathman. I appreciate the super chats this morning, guys. Thank you, everybody, for having your coffee with the Melonheads this morning. It is Friday, so we'll be back at 3:15 p.m. Eastern Time with our weekly wrap-up live stream. Thanks to my Patreon supporters for everything you guys do for the channel. Link down below should you feel so inclined. Hi, Mom. Hi, Dad. Love you guys. Till next time, live small and dream big.